which one should not ignore, especially the very high promising ones. There are a few of them. I think a good investor is one who's flexible and open-minded, who does not have any rigid boundaries, and he's open to change, adaptable to change.
In terms of industry and the expertise with regards to stock picking particularly, what factors do you prioritize when you're assessing potential investment opportunities?
First, because that's very important. So as an active investor, and there's no dearth of resources online today in today's day and age, but there'll come a day when the algos will do all the work and we'll basically not have any work to do. So every day I do go through all the corporate announcements on the Bombay Stock Exchange website. For many, it is very tedious work, but for me, it is like going through a gold mine where I may strike gold anytime. And I go through the press releases, investor presentations, M&A deal, joint venture partnership agreements. I also listen to the conference calls on platforms like Alpha Street, Trendline, Research Bytes, etc. And I also go through the management interviews and on various media platforms and social media and digital media. Along with this, I'm also always on the lookout for breakout earnings every quarter. So breakout earnings simply refers to situations where revenues have gone up more than 50% year on year and net profits have gone up by more than 100% year on year. Because in such cases, something fundamentally changing in the business. The business is gaining accelerating fundamental momentum. So it's a good starting point for further research. Along with this, I also attend investing conclaves like Tamil Nadu Investor Association or India Investing Conclave, attend all the webinars by SOIC. I also am in regular touch with my peers and colleagues in the industry on a daily basis for stock ideas. And you can also go through forums like Value Picker, Multiply, and we also have Twitter, WhatsApp groups, and Telegram channels. There is no dearth of information. There's a lot of information to go through. Deep dive on companies, you should go through the annual reports as well as the credit rating reports. For small cap companies and micro cap companies, credit rating reports often contain information which is not readily available otherwise. And to get an in-depth knowledge about any industry, go through the draft red herring prospectus, DRHP, as well as the QIP offering documents, because these two documents contain a rich level of detail about the underlying industry. In addition to initiating coverage reports, so equity research reports are another very good source for idea generation. You've got many high-quality brokerage houses which issue good quality equity research reports like Spark Capital, Equirus, India Infoline, Axis Capital, ICICI Direct, etc. So I think, reading and just being aware and up to date about what's happening in different industries, it's key to becoming a successful investor. And as Peter Lynch has taught us, more rocks you turn over, the more opportunities you find in this business. So, it's all about, how thorough you are in your research and how curious you are as an investor.
Yes, curiosity is extremely, extremely important. I have a little question over here. So what if somebody is not a full-time investor who can spend that amount of time in terms of going through all the resources to get to the stock? So say, for example, I'm comfortable doing a lot of research when it comes to evaluating a particular stock, going through the financials, con calls, etc. of a stock. But in order to be able to get to that stock, I'm not very comfortable in doing this much amount of reading and research, possibly because I'm not a full-time investor. Maybe I'm a finance professional, but not a full-time investor per se. So in that kind of a situation, do you think the screeners and all very quantitative kind of screeners are going to be working in any which ways?
That's a quick and easy way to get some stock ideas. You will not get all the stock ideas, but you'll get plenty of stock ideas by you setting up a screener on a tool like Tijori Finance or Screener.in. I don't have any affiliations with these tools, but I've used them as part of my daily work, so I highly recommend them. Along with this, you can also look at newsletters like the R30 or Regulation 30 newsletter, which gives you a daily summary of all the important corporate announcements. That you don't have to go through all the announcements on the Bombay Stock Exchange website. You can also subscribe to the RAP newsletter. It's a recent initiative by a very prominent social media handle by the name of Tar, and I think that particular newsletter, which comes weekly, also offers a lot of value. And basically, you can fast track your research process and stock ideation process by using these specific tools as well.
That's quite a lot of information sources actually. So we've talked predominantly about equity as an asset class while we are discussing. What asset classes are you currently investing in, and do you have any preferences with regards to that?
100% of my financial assets are in equity only. I don't have any fixed income investments as such. So I've kept my life very simple and very, easy to navigate. So apart from the cash in my checkings account and my home in US and my equity investment in my Stellar Partners India Fund to have skin in the game, that's basically my entire net worth in a nutshell. So I've kept my life very simple because when you're of a younger age, you should basically maximize your investments in equity, subject to having an emergency contingency reserve or a backup of at least 2 to 5 years of living expenses. As long as you have your emergency fund in place and you have adequate life and health insurance, I think after that, then you should maximize your exposure to equity. As you grow older, I talked about this importance of asset allocation in the making of a value investor as well. That if you want to have sanity and peace of mind in bear markets, what you do is as you grow older and mature, then you put aside a sum of money in fixed income instruments, which gives you a regular income sufficient to take care of your lifestyle needs. And basically that will help you maintain the calm and the composure during times of market volatility. Asset allocation is a very underappreciated aspect, but I think it becomes very, very important during bear markets.
Yes, I've actually seen a lot of research, very backed by data, wherein it's the asset allocation that determines a larger chunk of your returns as compared to security selection within those asset classes that you've done. And over a long-term horizon, again, it fades. It's more about the asset allocation than the security picks that we look at. So there would be absolutely no investment in terms of liquid gold or something that we would be looking at, or the startup space or the alternate classes. Anything at all?
Public equities are the space which I understand very, very well. This is where I feel most comfortable.
Okay.
This is where I have the most conviction. So, when you have high conviction in something, it enables you to hold on during periods of turbulence. This is why, I feel very comfortable investing in stocks in the Indian market, which I understand pretty well. So this is the reason. But yes, startups definitely is a place which one should not ignore, especially the very high promising ones. There are a few of them, and probably in the future, I may consider investing in a few startups. But as of today, I'm very happy just participating in the listed space completely.
So just to add on to that, basically what happens, a lot of personal finance is a very, very personal thing. It could depend on from situation, from an individual's situation to situation, and whether or not to invest in startup space, because a lot of misinformation also spreads in terms of finance, and there is a very clear understanding before you delve into investing in startups or hedge funds, for example, and also to allocate a very, very larger proportion to equity. For example, I am also very heavily invested into public equity. And I was having a discussion with one of the fund managers, and we were, just exchanging notes as to. So his context was that I would rather invest in a small cap stock than a startup, because I would be in a similar kind of a situation with regards to growth, maybe a micro cap, but I would have much more disclosures and information and understanding of that. It becomes a very personal thing, and people extrapolate very, very easily and very quickly when it comes to taking personal finance decisions. So one has to really understand personal finance and their own context before taking that kind of call. So moving forward in terms of personal finance, so you've talked about that by the end of bear market, how you began to emphasize on the return of capital as compared to return on capital, which you also mentioned today in one of the answers. So can you elaborate a little bit on this?
This is very, very important. In fact, in Benjamin Graham's definition of investing, even in the definition of an investment operation, he actually placed return of capital before return on capital. It's because you can temporarily make paper profits by investing in stocks of bad quality businesses during a bull market. But the moment liquidity tightens, economic conditions worsen, and once the bear market begins, then these businesses start incurring losses and you end up with permanent loss of capital. And in the investing field, the raw material is money, it is capital. So safety of capital should be paramount to any investment operation. And investing in good quality businesses led by good quality management is the key to long-term sustainable wealth creation. This is why, by the time this bear market ended, I had started to emphasize return of capital before return on capital, because it doesn't matter how much paper profit you make in a bull market. What matters is how much wealth can you retain after the recovery from a bear market. So once the bear market is over, have you been able to come back to all-time highs? Because in a market crash, both quality and junk stocks fall. Quality stocks with growth eventually bounce back to all-time highs, whereas junk stocks lie low for many years until the next bull run takes over. So this is on quality, prudent diversification, and safety of principle. These are the important things which this bear market taught me. This is very, very important. Experience teaches you these things, especially hard experience.
Yeah. So you talked about sufficient diversification. I have friends who are owning like 100 stocks. I've got friends who are trying to reduce the number of stocks to like a below 20. I am sitting on somewhere around 33, 34, 35 stocks or so. No, actually not 35, 30 stocks or so, because I've got 2, 3 different versions of sovereign gold bond and all. What is the number? Is there a number that you look at in terms of diversification?
So as per empirical data and studies published in the international bestseller, A Random Walk Down Wall Street by Burton Malkiel, was shown that as the number of stocks in a portfolio reaches 25 names, the incremental volatility reducing benefits of diversification reach near zero. So this is the sweet spot for an active investor seeking to outperform the market.
25.
At 20 to 25 stocks, you have captured almost all of the benefits of diversification. Yet the number of stocks you need to know thoroughly is still manageable. And this is the range of stocks which we hold both in our India fund in the US and in our PMS in India.
Okay, so I'm kind of 5 overboard or overshooting with 5 stocks. Okay, I'll bring down that. I'm not gone through this paper, but yes, I mean, we always talk about the trade-off in terms of, increasing the number of stocks and where the cost of managing is higher than the diversification benefit. So 25. Nice to have a number. I actually did not know this one. Your first 20 bagger after the bear market. So you striking that 20 bagger after the bear market. I mean, how did that happen and what was your investment thesis? So how did you spot that? And why did it have to be at the end of the bear market?
The Making of a Value Investor book ends with a quote by Peter Bernstein. It goes like this: survival is the only road to riches. Let me repeat that again for all of you. Survival is the only road to riches. Because I was able to survive the bear market of 2018, 19, and 20, and because I was present in the market and the bear market ended, I was able to capitalize on the subsequent big opportunity which I came across in early June 2020. The stock in question was a stock named Rajratan Global Wire. It's an auto ancillary company which makes bead wires for tires. It's a critical input in the tire manufacturing process. And this business was available at a trailing P multiple of 5 times on depressed earnings. And the reason for such a abysmally low valuation was that after the 2018 NBFC crisis, the Indian auto industry ended a severe down cycle. And because the entire auto industry was out of favor, investors' attention on this particular auto ancillary stock was also very low. But as soon as the auto industry started showing the first signs of revival, and this company had undertaken a big capex during the down cycle, once the earnings from that capacity expansion also started kicking in, you got the benefit of both earnings growth and valuation re-rating, and you ended up with a big multi-bagger. So this was my career's first 20 bagger. And this, again, it goes on to emphasize that, time in the market is more important than timing the market. If you're out of the market, because of fear of a market crash or market fall, you end up missing these big opportunities. So you have to take the pain if you want to enjoy the long-term gain. There is no way around it. This is basically how you deal with the bear market. The answer lies in the statement itself. Deal with it. In this book, The Making of a Value Investor, if you go through my journal entries in July and August 2019, you will see that there was complete utter despair and panic among investors and a sense of despondency. When I had become very despondent, skeptical about myself as well during that particular period, because nothing seemed to be working. Even stocks with good earnings were being trashed in the market. So when stocks of good businesses with good earnings display is also getting decimated, then you just start developing a sense of disbelief as an investor that maybe equity is not the right asset class for me. And this is when the bear market typically comes to an end. After August 2019, in September 2019, we had the big corporate tax cut announcement. After which the market tried hard to stabilize, but then again, that was just a sucker's rally in a bear market, because bear market rallies basically just suck you in, make you think that the pain is over, but that's not the case. End of March 2020, the last bull basically had given up, because the small cap indices in India had fallen almost 55% from their high, The mid-cap index had fallen more than 45% from their high over that time period in this bear market, and thousands of stocks in India crashed 60 to 80% during this time period, including stocks of good quality small cap and mid cap stocks. And this is when your character, your temperament is truly tested. And until you've been through a very long bear market, you have not really been tested as an investor. I think that's why in hindsight I actually thank that period of my life, because even though it was very very difficult and excruciating, but it has given me valuable lessons for the rest of my investing career. And I think this will hold me in pretty good stead for the next few decades.
I'm sure it will. So I've actually noticed a lot of people with a relatively low understanding of finance. They enter in the markets the moment the bear market kicks in, and they'll immediately have a negative connotation about the market. They would not want to stay in the long term, and they'll go back to the real estate investing. So in India particularly, we've been kind of obsessed with one, real estate, and two, gold in the forms of investment. And because you're seeing that tangible real estate and it is appreciating or static, if not depreciating at least. So somehow there is a sense of solace people find, but they don't look at the long-term compounded annual growth rates, CAGR and all, when they're evaluating the real estate aspect. So yes, survival and being through with the market is very important. And totally agreed on the point that timing the market is actually very, very difficult. It's more about the time spent in the market, wherein the long-term compounding kicks in. The next bit, so you've been talking about small and mid-cap per se. So should I assume you're predominantly invested in small and mid-cap space, and do you look at the large cap space at all, or you kind of finding more value in the small and mid-cap space?
Well, our PMS and our India fund is market cap agnostic, and broad-based bull market like we are in right now, we'll find the highest growth in the small cap and mid-cap space. That's where most of our portfolio is focused on right now. But in the future bear market, when large caps assume leadership in terms of growth, this ratio right now, which we have in small cap, mid caps, that ratio may be reversed in favor of large caps as well. So, I think a good investor is one who's flexible and open-minded, who does not have any rigid boundaries, and he's open to change, adaptable to change, and just be with good earnings growth, good capital efficiency, that is good returns on capital employed, good quality promoters, be it small cap, mid cap, and large cap, micro cap. These principles apply across the board, and just be with growth. I think growth is a very important component of value creation, because high returns on capital employed or high ROC without growth turns out to be a value trap. Look at lubricant stocks like Castrol, for example. Super high returns on capital employed, but there's no growth. That's why the stock is stuck in a range for many, many years. So this is not stock recommendation. I mean, do not have this stock in any of our investment products, but just, India is a growth market. This is not a market where you basically you should avoid paying 70 P multiples for 10% growth. I'm fine with paying high P multiples for high growth, but I'm not okay to pay high P multiples for single digit or low double digit growth, because that doesn't really suit the purpose. In the former case of paying expensive valuations for slow growth companies, you're actually opening yourself up to the possibility of permanent loss of capital or incurring huge opportunity costs. Because even though these large cap quality stocks may benefit from passive index flows, subpar earnings growth, they will not really give you the big delta in your portfolio appreciation. So in the making of value investor, I've actually talked about this, that most successful investors' journey in the market follows a typical template: multiplied in cyclicals and special situations in the early years, and then compounded in quality in the later years. First, you become rich by investing in cyclicals and special situations, and after that, you safely compound in quality in the latter half of your investment career. That's basically how all big investors typically invest.
Okay. Interesting. So again, it goes with the kind of your risk-taking ability changes with your lifespan, and accordingly you churn your equity portfolio. Within equity portfolio also, you're trying to manage your risk aspect as you age, is basically what we're looking at. I often tell my students that you should learn from other people's mistake if you want to expedite your career, if you want to move faster, so that you don't make the same mistakes. You leap those mistakes and make the fourth or the fifth mistake as your first mistake. So you kind of move very fast. So with respect to investing, so what are the mistakes that you've learned from, or what are the mistakes that you can prevent the students from making while making investments?